Welcome to this explainer from Finbot Insights. Today, we're going to distill 5 foundational principles of investing. Now, these aren't just suggestions or clever tips. Think of them as immutable laws that really govern portfolio outcomes, essential knowledge for any discerning income investor. Our journey starts with the first, and you could argue the most crucial law. This statement here seems obvious, right? But its wisdom is probably the most frequently ignored principle in the entire world of investing. Before you can even begin to think about growth, you first have to master preservation, because protecting your capital is the absolute prerequisite for growing it. To really appreciate this law, we need to move beyond just the saying and actually quantify the impact that significant losses have on your long-term growth. You see, the mathematics of loss and recovery, well, they aren't symmetrical at all. Okay, let's really dive into the data here. I want you to consider a study of the S&P 500 during that really turbulent decade from 2001 to 2010. We're going to compare 2 hypothetical portfolios, and each one starts with $100,000. The first one just bought and held the index, writing out all the ups and downs. The second one did the exact same thing, but somehow miraculously managed to avoid the 10 single worst trading days of that decade. The difference in the outcome is just staggering. The standard portfolio, the one that held on through everything, it grew to just over $113,000. But the protected portfolio, the one that simply sidestepped those 10 catastrophic days, it grew to over $232,000. It more than doubled the final value. It's a brilliant illustration of the raw power of preserving capital. And that understanding of capital preservation leads us directly into our second law. This is a concept that completely reframes the very nature of what an investor is actually buying when they enter the market. Just think about the investment process from your perspective as a retail investor. You provide the capital. The company's management team then executes a strategy with that capital. And then what? You're basically left to hope for a positive outcome. The key thing to realize here is that you have no direct control over that strategy or how it's implemented. So, this is the crucial point. You did not purchase a guaranteed return. The return is just the potential output of this whole process. The only thing you purchased with certainty, the only input you truly control at the moment of that transaction, is the risk associated with that company, its industry, and the market as a whole. So if risk is the input that you can actually control, our third law identifies the main force that causes so many investors to mismanage it. And this force, it doesn't operate in the market. It operates within you, the investor. Now, what's really fascinating about this data is what it tells us about market behavior. This shows the 10 best and 10 worst single-day moves in the market over a 20-year period. And while the size of the gains and losses might look pretty similar, if you look closer at the dates, it reveals which emotional force, greed or fear, is really the one in charge. Look at this. 6 of the 10 best market days happened right in the middle of the 2008 financial crisis. These weren't signs of a healthy, greed-driven bull market. No, they were sharp, almost desperate rebounds in a sea of pure panic. And this is so critical because it proves that market declines, which are driven by fear, are far more violent and swift than the steadier climbs driven by greed. Fear is simply the more powerful market force. And those violent market swings that are caused by fear bring us to our fourth law. This one is a mathematical certainty that silently eats away at your portfolio's value over time, even if your average returns look perfectly acceptable. This simple math test really shines a light on the destructive effect of volatility. I want you to consider 2 portfolios, A and B. Believe it or not, both of them have an average annual return of 0% over 4 years. But portfolio A is highly volatile, with these huge 30% swings, while portfolio B is much calmer, with only 10% swings. So, despite having the exact same average return, the outcomes are vastly different. The more volatile portfolio A ends up with less than $83,000. Meanwhile, the less volatile portfolio B preserves $98,000. And why is that? It's because every percentage of value you lose requires more than a 1% gain just to get back to even. That drag, that is the destructive power of volatility. This brings us to a really powerful way to think about this dynamic. If that steady, patient force of compounding is the Superman of investing, then high volatility is its kryptonite. It doesn't just slow growth down, it actively attacks and weakens the very engine of long-term wealth creation. Finally, Even if you manage to successfully navigate the first 4 laws, there's a 5th immutable law that determines what portion of your returns you actually get to keep. Any successful investment strategy has to be tax-aware, because at the end of the day, it's not about what you make, it's about what you keep. Short-term gains, many forms of investment income, they're taxed at your highest marginal rate. This means that strategies with a lot of buying and selling can create a major tax drag, seriously diminishing the capital you have left to compound for your future. So, to summarize all of this, these 5 laws provide the essential foundation for a durable, long-term investment strategy. What they do is shift your focus away from chasing an uncontrollable output, the return, and toward managing the inputs you can actually control: your risk, your emotions, the volatility you accept, and your tax efficiency. So we'll leave you with one final and I think critical question. Is your strategy built on the unpredictable nature of hope, or is it built on the enduring strength of discipline? An honest answer to that question might be the most valuable investment decision you ever make. Thank you for joining us for this FinBot Insights Explainer. If you found this analysis valuable, please support our work by clicking like and subscribing for more data-driven investment content. We appreciate you watching.